Good morning. We are live. It is Monday, July 8th, and this is the deep dive with Keeping Current Matters. My name is Kate Rezebeck, and I'm so excited to be here with you today, starting the week off talking about the most important topics in the housing market. As always, KCM members, welcome back. Thank you for coming back week after week. And if you're new to the deep dive today, welcome and thank you for joining us. We're going to have all the slides available today for download. So if you're a KCM member, you can find those in the member area. And if you're not, check out trykcm.com and you can download the slides there. We're going to pop that into the chat for you so you have a link to go directly to it and check out everything you need to know, because what we're bringing today are visuals and all kinds of data and insights to help you have the most meaningful conversations with your clients. The thing we're going to be talking about today is a really important topic that our research team has been looking at very recently. And it's about overcoming today's misinformation about a housing market crash. This topic continues to come up in headlines and articles, and it's out there. You're seeing it, your clients are seeing it, people are thinking and feeling it. So what we want to do is bring you the data and the insights to help overcome this misinformation that's out there. There's really kind of this disconnect right now that we're finding that people are feeling about the economy and the housing market and what's actually happening. So bringing you the facts, bringing you the data, bringing you everything that you need to be the expert for your clients. So you're going to want these slides. You're going to want to talk about this because it's on your clients' minds right now. They're seeing prices going up. They're seeing inventory rising, and that causes fear and concern. We're going to break that down for you because, spoiler alert, we are not headed for a housing market crash, and I want to make sure that you have all that insight for you as you chat with your clients and have those meaningful conversations. So we're going to dive right in and get started. And I want to show you first some of the headlines that our research team has come across. Jamie, Alex, Nikki, they've been digging into this. And here's what they're seeing as they're looking at a lot of what's coming up in the media right now. Is the US headed towards a recession? Home prices are soaring. Is this another bubble? Is the housing market going to crash? When will the housing market crash? And these just kind of keep going on and on and on, because bottom line, people are scared. They're not sure. And they're starting to form these opinions as they look at what's happening with prices, what's happening with inventory. And the reality of it is that's the disconnect of what people are thinking and feeling and what's actually happening. So I want to break that down for you today. And we're going to start by defining what is a recession. So what is a recession? It's a significant, widespread, and prolonged downturn in economic activity. Common rule of thumb is that 2 consecutive quarters of negative gross domestic product, or GDP growth, indicate a recession. However, more complex formulas are also used to determine recessions. So this is the general principle or the guideline for what a recession is. And if you take a look at what's happening with GDP in this country, this is real gross domestic product, and it goes back to 2019. And what you can see over on the right side of the screen is that we've had 7 consecutive quarters of continued growth. And so GDP is growing. We're seeing that in the economic data. And there's even a little debate as to whether in early 2022, those 2 quarters were actually a recession. But the general principle and what the data shows is that we're seeing economic growth in the economy right now. However, here's what people are actually thinking and feeling. Nearly 3 in 5 Americans wrongly believe the US is in an economic recession. So 56% of people in this Harris poll that was done think the US is experiencing a recession, and 55% believe the economy is shrinking. So that's not what the economic data is saying, but it's what people are thinking and feeling. And if you continue to read through the Harris poll that our team found on this one, the analysis says what Americans are saying in this data is economists may say things are getting better, but we're not feeling it where I live. So people aren't feeling it. They're feeling like this just feels off. And that starts to drive those fears of we're headed for a recession, the economy is not doing well, the housing market is going to crash. It starts to kind of spiral in that direction. And, perception is reality for a lot of people who are thinking and feeling this. So let's take a look at why our perceptions are so distorted. This is from the Washington Post, and it says, to be fair, some economic jargon means specific things to economists, but it's used differently by normal people. So what does that mean? For example, to economists, recession means that the economy overall is measured by output, employment, all of those things that economists are looking at, is shrinking. But lay people often use the term more loosely to mean something feels bad about this economy, such as high gas prices. So this difference in usage might account for why the majority of respondents in that Harris poll believe we're in a recession now, while almost no professional economic forecasters agree. So that's the disconnect right there. The definition of a recession and what people think and feel are often in conflict if it just feels off. Washington Post goes on to say, in reality, the US economy has been growing consistently for nearly 2 years, even after accounting for inflation. By virtually every benchmark, in fact, we're exceeding growth expectations. US economy has been outperforming other advanced economies. We're also doing better than pre-pandemic forecasts had situated us by now, both in terms of gross domestic product and the number of jobs out there. We even saw this in the jobs report last Friday. Strong but cooling job market. All of these things are coming together, and people are just thinking it feels off than what's actually happening in the data. So when people start to think and feel these things, it rises to the top, it bubbles up. And then they start to think, is the housing market going to crash? And so that's what I want to break down for you, is what the data shows on a housing market, the risk of a housing market crash. So let's take a look at that specifically. What is a housing market crash? Well, in general, US News says a housing market crash is defined by a rapid decline in values, leading to a peak to trough fall of 20% or more, home values, which is what happened in the aftermath of the financial crisis in 2007, 2008. So people see home prices rising, they see inventory rising, they think, uh-oh, here we go again. But what I want to show you is why this is unlikely right now. US News continues on and says, today, the combination of this lock-in mortgage effect for homeowners, we've talked about that a lot lately, more millennials purchasing homes, and population growth returning to pre-pandemic norms will continue to add the pent-up housing deficit, which was recently estimated to be 4 million units by Bank of America analysts. As long as demand exceeds supply to this extent, a housing market crash is unlikely, absent economic shocks, including surges in employment, delinquencies, foreclosures, all those other factors that could be involved. But bottom line is we just really don't have enough inventory right now compared to demand for prices to fall. That's what we're talking about. Demand exceeds supply. And that's really where we are today. But here's the thing. A lot of people just don't think that is true. And our team actually found this really interesting study. It was actually done in October of last year. So October of 2023 by LendingTree. And LendingTree asked respondents, do you think the housing market is at risk of crashing in 2024? And last fall, 44% of people said yes. It was higher among Gen Z and millennials, so younger generations, maybe people who haven't lived through quite as many housing cycles. But 44% of respondents said yes. And what's interesting about this is this study is kind of continuing to sort of pop up, and it's informing some of the headlines that are out there today. What we have to remember is that the housing market was in a really different place last fall. Mortgage rates were up, over 8% at that point. And a lot of things have changed since then. So 44% of people thought the housing market was going to crash in 2024. And this continues to resurface. But what's also interesting is our team dug in a little deeper on this survey, and that same survey from LendingTree asked respondents, do you think a housing market crash is the only way you could afford to buy a home? That's a really interesting question, because the same people who responded to that survey said, yes, 32% said the only way I can afford a home is if the market crashes. So as people are responding to these surveys, what we have to remember is they're not always the ones looking at the economic data. They're not always looking at what's happening in the economy, what's happening with inventory, with prices, with all of those things that actually determine whether the housing market is going to crash. But they think and feel this. And so there's that disconnect, that misinformation starts to spiral. And I think Business Insider really sums it up well. It says, though many Americans believe the housing market is at risk of crashing, the economists who study housing market conditions overwhelmingly do not expect a crash in 2024 or beyond. And that really comes down to two things that I want to kind of draw your attention to today. It's inventory and prices. Because when we look at these two factors in the housing market, we can see that they're not setting us up for a crash in the months ahead. And we can start with inventory. As Lawrence Yun, chief economist at NAR, says, there's just simply not enough supply. So the economics of supply and demand, if there's a shortage, prices simply cannot crash. We've talked about this a lot. If there are more buyers for something than there are of that item available, prices tend to rise. Buyers compete for those items, and that's still what's happening in the housing market. Now, we've seen buyer demand ease a little bit as mortgage rates have been higher, and that's eased demand a little bit, but it's certainly not enough for housing prices to crash because inventory isn't growing that fast. So let me show you what that looks like. This is the average annual inventory of homes for sale, and it's month supply going all the way back to 1999. So 24, almost 25 years of data right here, showing that the average month supply, or that kind of ratio between buyers and sellers, has been about 5.3 months. Now, there's debate as to whether 4 months or 6 months is a normal neutral market, but where we are right now is far below that average. If the average has been 5.3 months, we're kind of climbing in that direction, but we're not close to being there. And you can see that as we zoom in on this next slide. The month's inventory of housing supply has been rising this year since January, all the way up to May, the latest data that we have. We can see it inching up, but it's not even up to what is average. So we still are undersupplied. And, like we said, a lot of this supply is due to a little bit of ease in buyer demand. We've seen that happen with the reality of where mortgage rates are in the housing market, but we certainly don't have an oversupply that would cause prices to crash. And that's a really big, important takeaway. So inventory is lower than where it would need to be, much lower than where it would need to be for home prices to crash. And the other thing we want to look at is prices. And this quote from Zillow says, in 2024, I expect we'll see home price appreciation take a step back, but not a plummet. So what does that mean? That means prices continuing to rise, but at a slower, more moderate pace. We've been seeing that for quite some time. We've been talking about, hey, in 2024, prices are going to continue to rise, but the pace is going to slow. It's not going to be as exponential as it was a few years ago. And this graph right here is a great one to share with your clients to talk about where prices are, because this goes all the way back to January of 2022. And you've seen this before, but it shows home prices are moderating. So what we had a couple of years ago was home prices accelerating at a very fast pace. People thought this isn't sustainable. We're going to head for a crash. And where we are right now is home prices have eased. They've moderated. And if you look over at the right, they've really kind of plateaued based on mortgage rates being higher and easing demand. But we don't have enough supply for them to skyrocket up or drop down. So, to drop down or decline. So we're not in a place where home prices are skyrocketing. We're not in a place where home prices are declining. We're really in that moderating pace of home price appreciation, and it's based on that supply and demand. This is a great graph to share with your clients to help them understand where prices are right now. So as we sum this up, Forbes says, as already high home prices continue trending upward, you may be concerned that we're in a bubble ready to pop. We saw that in some of those headlines I shared with you at the beginning of this session. However, the likelihood of a housing market crash, a rapid drop in unsustainably high home prices due to waning demand, remains low for 2024. And that's the bottom line right there. We just don't have enough supply for that to happen, for home prices to decline rapidly. We're really in a place where being able to talk about this, share these visuals with your clients can help ease their fears, because what we know is that the reality of what's happening in the data is different than what people think and feel right now. And helping them understand what's actually happening is mission critical to helping your clients make powerful and confident decisions. And as we always say, most agents know what's happening, good agents understand it, and great agents can explain it. And if you take these slides, you take these visuals, you share them with your clients, you talk about what the data actually says, you can ease those fears and you can be the expert that they turn to. And that's what changes the game for your clients, is they make decisions going into the next part of the year. And as they think about what's actually happening in the housing market, where their fears are, how to ease them, all those different things. And of course, we always give you some content to help with that. If you're a KCM member, we have a great blog today that you can go and check out, Why the Market Won't Crash. We have even more data and insights to share on Instagram, video scripts to use to record, so you can get out there, you can start talking about why the housing market won't crash. You know, there's a lot of misinformation, there's a lot of misconceptions, and we want to give you the resources to be able to check that out. So those are there for you KCM members. If you're not a member, try kcm.com. You can give it a shot and use these with your clients in your most meaningful conversations. And speaking of meaningful conversations, David Childers will be back with you next week as he talks about getting your mindset right, knowing that the changes for the NAR settlement are going to be about a month away, and making sure that you have the mindset, being the educator, the expert, the things that you can control going into that change for the housing market, and all the things that you can do as you make that switch next month. So we'll see you next week, July 15th, 11 a.m. Eastern time. Thank you so much, and we'll catch you there.